What's up YouTube? Dougie Chong here. Welcome to today's episode where I'll be going over exactly what options trading is, and I'll be giving an example of a put option trade. To start the video, I'll say that if you're a beginner investor, I would not recommend trading options. It is an easy way to lose a lot of money really quickly. Even myself, who has been trading for over 10 years, I do not buy options that often. And another thing to note is that options trading is also referred to as futures trading or derivative trading. That's because it involves buying shares in the future or selling shares in the future, and derivative just means it's based on a certain asset class. So when it comes to options trading, there are two different types. There's a call option and a put option. A call option gives you the right to buy a share at a certain specified price by a certain specified date. And a put option is the exact opposite. It gives you the right, but not the obligation, to sell a stock at a certain price at a certain specified time. This distinction between right and obligation is very important because let's say the stock shot up to $1 million, but you have the right to sell it for $100. You would obviously just sell it for the market value of $1 million instead of selling it for the option price of $100. I'll probably go over which one a call and which one a put is quite often because frankly I get them mixed up a lot. They are very similar and it's not exactly clear why one is called a call option and the other is called a put option. I actually did a quick Google search to see why a call option was named the way it is, and a call option is named a call option because you're basically calling up the person you made the contract with to buy the stock. You're saying, hey, remember when I made that contract to buy Amazon stock for $100? Well, I'm taking you up on the offer now. And a put option is a little more negative. You're kind of putting it to that person that signed the contract. You're saying, hey, I'm giving you this stock at this unfavorable price. I'm putting it to you. By the very nature of these calls, a put option is negative on a stock. It is very bearish. It means you think the stock is going to go down in price. A call option means you are very bullish on the price and you think it'll increase in price. I like to use a different way to remember call options and put options. So call, I do the same, call up, but more like you're calling up a friend. So when you're doing a call option, you're thinking the price will go up. But put, it's down. You're doing a put down. You're like putting someone down. That is how I like to remember the difference between a call and a put option. In this video, I'm just going to go over a put option example because it is the only way you can kind of bet against the market. If you are really bullish on the market or a stock in general, you can just buy the stock, and I really recommend just buying it and holding it instead of buying a call option. You are also able to short sell the market, but I'm not going to go over that in this video. Let me know in the comments below if you want me to make a video on short selling or a video with a call option example. Before I get into the put option example, let me just mention that in order to first buy or sell options contracts, you have to first set up a margin trading account. This effectively allows you to borrow money from the bank to buy and sell stocks. It's important to note that this feature is currently not available in the Wealthsimple Trade app. It is available in things like TD and Questrade, but to set up a TD account, it took quite a bit of time. So if you want to start trading options, I suggest you start opening a margin account as soon as possible. Alright, for this example, I'm going to use TD's direct investor platform. So when you place an order, instead of going to the typical stocks and ETFs tabs, you head over to the options tab. The underlying stock I am going to place an options contract for is for the stock VFV. This is a stock that tracks the S&P 500 index. If you want to know more about this stock, I'll leave a link in the description below. Under the options tab, you will find the strike date. This date is sometime in the future, and it means from any time between now and the strike date, I can sell this stock at the strike price. The strike price is shown a little to the right there. It's important to note that this is not the price of the options contract. This is just the price that you have the right to sell the stock at before the strike date. You can see here if the stock falls below the strike price, you are making money because you are able to sell the stock at that higher price. However, if the stock goes above $62 in this example, you will be losing money. You are what's known as out of the money, and if you are making money, you are known as what's in the money. And then you can either put a put or a call option. I'm just going to put a put option for now. And then you can either buy to open, sell to close, or buy to close. I'm just going to do buy to open right now. It's the easiest one to understand. You can kind of borrow shares first, but this is kind of the easiest way to start with options trading. Then, just like placing an order for a stock, you can do a limit or a market order. I will just do a limit in this example. And on the right, you can see what it's currently trading for. It's important to note that for a lot of options trading, the volume of trades is a lot lower than the underlying asset. This makes it harder to make trades. One time I actually guessed the direction of the stock correctly, but I ended up taking a slight loss because there was just not enough volume trading on that option. I could have tried to buy the stock and exercise the option, but I'll disclose I have not physically exercised an options contract. I just kind of try to buy and sell them so far. But the stock market was kind of crazy at that time. It was being halted because it was dropping too quickly. So I just tried to get rid of the contract as fast as possible. Another important thing to note when it comes to buying options is they typically come grouped in 100. This means that instead of buying just one contract, it's actually 100 contracts. So when it says $3, it's actually $300. This means you have the option to buy or sell 100 of the underlying stock, not just one. Alright, now let's say you bought that options contract for $3 at a strike price of $62, and let's fast forward to the future. There's one of two things can happen. The stock price can go up or it can go down. I guess it can also stay the same, but let's say it goes up to $64, you will have lost money. You will have known as what's out of the money. This is because your put option gives you the right to sell the stock at $62. But the stock is selling at $64 market price. So you'd rather just sell it at that market price instead of the options contract price of $62. On the other hand, let's say the stock price falls to $58. You're glad you're holding on to that put option contract because it gives you the right to sell the stock at $62. So you could theoretically just buy it at $58 market price and then exercise your contract to sell it for $62. I'll summarize the possibilities with this small table. If on April 17th, the value of the stock is over $62, the value of your option, your put option, is zero. It's worthless. This is why options trading is so risky and I do not recommend it for beginners. If you buy a stock that kind of tanks, it'll go down, but it probably won't go to zero unless the company goes bankrupt. And if you just hold it long enough, it'll eventually climb back up. Options contracts, on the other hand, once they hit that strike date and you're out of the money, they are literally worth $0. Alright, now let's say if the stock went down to $60. So it went down, but not down that much. The value of your options contract would be $2. Since you bought it for $3, you're still taking a $1 loss, but at least it's not worth nothing. And now let's look at the best case scenario. The stock dropped to $58, the value of your options contract would be $4. Since you bought it for $3, you're up $1 per contract. And to sell the contract, instead of doing a buy to open, you do a sell to close. Again, you could exercise the contract, but I'm not exactly sure how to do that as of yet. And the commission for a group of 100 contracts is about $12 using TD. That's a little more than the commission of $10 for buying and selling stocks or ETFs. That's it for this video, guys. Hope you learned a lot about put options and options in general. I know this is a pretty boring Econ 101 topic, but I tried to make it as exciting as I could. It's important to understand options trading, even if you're not gonna do it, just to understand what other traders are thinking, and it's important to know put options in case you wanna bet against the market. There's all sorts of strategies and protective measures you can use contracts for, especially to hedge your bets. That's why they're called hedge funds. See, the more you know about investments, the more you'll know about the world. I know this video was a little different from my typical stock reviews, but leave a like if this video helped you at all, and subscribe if you have not already. As always, enjoy the rest of your day and catch you in the next video.